Hi, everybody. Welcome to the Pearl Planning Winter Economic and Investment Outlook webinar. It's Melissa Joy here, joined by Melissa Fradenburg. I'm going to share our screen and we are going to get started. Thank you for joining us. And if you have to bow out a little early, we will definitely also be having a replay available on YouTube. We will send it to everyone who registered, and we appreciate you attending. Sometimes when markets are good, our attendance goes down. And then when markets are bad, our attendance goes up. But I think we have a lot of great advice for any market today. Very excited for the presentation, and of course, very excited to have Melissa Fradenburg here with me, also from Pearl Planning. Melissa, welcome.
Hi, everyone. Thanks for joining us.
And today we are going to be talking about really the topics we think we're talking about with clients about in our regular conversations when it comes to investing in the economy. First of all, we're going to start with what the heck is going on in the economy. I think that expectations have been quite negative, and the actuality has been less so far. We'll talk about why and what's going on there. And then, it's unavoidable. The election year is here. And so we want to talk about how markets behave during election years and just in general. And then we'll dive deeper into stocks and bonds. Finally, we'll wrap up discussing your perspective and time frame, how you should look at markets and where you go from here. So without further ado, I've just got a couple kind of framing exercises as we get ready for Melissa to talk about the economy. And I want to start off by looking at predictions from top economists around the world. This is a Financial Times survey that's done quarterly, but we're looking at details from the end of 2022, what people thought was going to go down in 2023, which of course now we know all the answers. We have the answer key. And as of the end of 2022, 85% of people thought that the market would, or the economy, excuse me, would be in a recession. So 85% of the experts that are paid to know what's about to happen were sure that a recession would be here by right now, first quarter of 2024. And of course, we're still waiting for that recession if you're looking for one. And so Melissa's going to talk a little bit about what's really going on in the economy. But I'll tell you, if you're just out there kind of looking through headlines or really trying to understand what's going on, people are really still trying to make the data fit with their narrative. And I love this Simpsons cartoon saying, have I been wrong about the economy? No, it's the data. It's not me. There's not a lot of humility when it comes to this. And, people are still searching for something that might not be findable right now. And then here's an example in your recent New York Times headline. The US seems to be dodging the recession, but what could still be going wrong? So, we just want to set a framework that recession everybody's been looking for hasn't happened yet. And that goes with our theme that you can really get distracted if you're looking for predictions or someone who knows the crystal ball. We say this all the time, but it's even more, there's just more examples in the past year of why that is kind of a fool's errand. So I'm going to hand it off from there. I think what we've just said is we are not going to be forecasting because we think that's a fool's errand. We will talk about probabilities and what we see. And with that, Melissa, it's over to you.
Thank you, Melissa. And yes, with that success rate of economists, I'm certainly not going to be giving you predictions on the whether or not we're having a recession. But I am going to share with you some data, which I think is promising if we look at what our economy looks like right now. So one of the biggest things when we look at the economy is the labor market. And if we look at current US job openings in the purple here in the first graph, we have come off those highs from last year, but we are still historically quite high in job openings right now and quite healthy. If you look at the unemployment rate, just slightly above the all-time low at 3.7%. That is that's very healthy economic data to look at. If we look at labor force participation just below that in the blue, we see that it has come up quite steadily since the pandemic lows. Overall, there is a downward trend, but that has mostly to do with the aging demographic in our country, with baby boomers retiring. So again, that data looks good as well. If we're looking at real earnings for the average US hourly employee year over year, pretty good number, up 4%. Below, though, if you look at real average hourly earnings, which factors in inflation, as we know, we've had high inflation. So you see back in 2023 in the blue there on the bottom graph, but we are back positive year over year. We're seeing a little tick up in, again, real average hourly earnings. So that is also a good sign for the economy. The housing market, that was a big headline last year, is what's going to happen with the housing market with rates going up so quickly, and specifically mortgage rates hitting a high for recent years. Last year, we see in the last 2 months, both the 15-year and the 30-year mortgage have come down quite quickly from those highs we saw in 2023, with the 30-year being at 6.6 and the 15-year being at 5.9, and that was through January 22nd. So pretty recent. Good for people that are out there looking to buy a home and need to get a mortgage. Housing prices have come down slightly from those highs, but still very healthy, held up very well with those high mortgage rates that we saw last year. So again, positive data, and that's what we like to share. And in fact, we see promising headlines to that effect around the world. In Europe, unemployment is at a record low. We see mortgage rates coming down, and also inflation slowing faster as well. Now, another positive sign is net worth levels are up. So when we see all these positive headlines, we like to point those out because, as Melissa pointed out in the opening, you can certainly find the doom and gloom headlines if that's what you're looking for. But again, we wanted to share that there is positive news on the economy, both here in the United States as well as around the world. On the next slide, I will share there are some indications that growth may be slowing, but again, the Fed raising rates, the purpose of that was to slow the economy to help tamp down inflation. So just to kind of point out some of the things that have shown there are, as far as increasing unemployment claims, a healthy number overall, but we are seeing a little tick up there. Service and travel spending is softening. Hotel occupancy is at a seasonal 3-year low. But again, that's coming off of the pandemic highs. And restaurant performance is slowing slightly near low levels in the last 3 years. Luxury watch prices are at a 2-year low, but that could be due to this. Most people using their phones for watches now. And then architecture billing is slowing. So these are just some data. And I will point out as well, Melissa and I decided we are gonna keep the R word to a minimum here in this webinar, but recessions are not unheard of in a presidential election year. You see by the graph on the right there, year 4 of a presidency is a little bit higher percentage of a recession. And I think that may be the last time I use the R word, Melissa. So let's talk about the election. It's on everybody's mind. And again, no matter which side of the political spectrum you fall, it's on your mind because it's a big election year. And in fact, not just here in the United States, but more than 50 countries will hold elections in 2024. And 40% of the world's citizens will be eligible to vote in these elections. So that's just an interesting statistic. If you think about almost half the world's population voting this year, and in fact, 7 of the largest population countries have an election this year, including us, the United States, and India. So a lot of people going to the polls. One thing with election is it does sometimes bring uncertainty, which the market doesn't always love. So it's something, again, that I understand if it is on your mind and we hear it from clients. So we're going to share, again, some historical data to kind of talk about what we've seen in markets in election years. First up, election years have never been lower after a red midterm year. And by red, I'm not talking about Republican or Democrat. I'm talking about negative returns for the S&P in a midterm year. So here we see, again, this chart is going back to the 1950s. We did have a negative 19.4% in the midterm year in this current election cycle. So historically, that would suggest that we have a good chance of having a positive year in an election year this year. And in fact, if we look on the next slide at re-election years, meaning 4 years into a potential term. So, Biden is up for re-election. The last 11 re-election years have all been positive for the market. So again, looking back at history, that is something that we look to see what could we expect for this year. And if we look at those re-election years, so there were 11 of them here, are the actual returns. And again, I want to point out the mix of this is with Democrats and Republicans. Both of those in the election year were positive in a re-election year. So that is really hopeful data that we look at, thinking about what we could expect. And what we see, though, is more volatility in election years with uncertainty. Again, one thing the market does not like is uncertainty. One thing we have with elections is the uncertainty of policy and which party would be in control. What I want to point out, though, is compared to non-election years, the volatility typically happens during the primaries. And we believe the reason for that is you've got even people within the same party going up against each other and really pointing out what's wrong with the economy, with our country, with policy. So it does tend to, again, cause some volatility in the market. In this chart here, though, we look at really not, if you were of the thought that I'm going to wait until after the election, see what the outcome is and invest then. Really, if you go to election years, that volatility occurs between January and May 31st, which is typically the end of the primary season. So if we see here, historically, if we go back all the way to 1932, the average return for the S&P in the 12 months following the end of the midterm election, so from May 31st of an election year, 12 months out, is 11.2%. Again, average annual going back to 1932 in election years. So that's really positive. And not just looking at the full year, this is a very short-term period. We're not just talking about January through May, and then May 31st, you should put more money in the market. That is certainly not what I'm suggesting. I'm just pointing out that that volatility that we see usually has subsided by election time, and positive returns typically, or historically, I should say, have happened in those 12 months following that end of the primaries. Again, with wanting to point out that whichever side you fall on, Democrat or Republican, over time, we've had both. And I love this chart. Actually, I think this might be my favorite one, Melissa, in the entire presentation, because what it shows is no matter which party is in office, over time, the market has gone up, and really showing that the outcome of an election really does not change the direction of the market over time. And if you are a client of ours and an investor long-term, that no matter which party ends up winning the election, that over time we should still be able to see the market go higher. Interestingly enough, though, if we look at investor behavior, so I just talked a little bit about what we see in the market election years and what we see as far as returns in an election year. If we look at investor behavior, typically people are putting more money in an election year into money market versus equities. So on this chart, the green are money market funds, which are historically stable value funds, and the equity is in the blue. And you see here that investor behavior historically is putting more money into those stable value money markets in an election year with the thought that they will wait. And if you see the inflows into equity funds in the first year of a presidential, after a presidential election, you see that they're doing the opposite. So a lot of times what feels right to investors and what their behavior is the opposite of the actual what you should do. So I like to point that out. And then maybe I lied, actually. This may be my favorite, especially of the election slide. So take that back. This one is pretty powerful. What I'm suggesting here is to stay fully invested regardless. So if you were to put 10,000 back in 1949 and leave it in, no matter which party was in office, you can see in the black line that your assets over time would grow. If you were to say, okay, I have $10,000, but I'm only going to have it invested in the market when a Republican is in office, that's represented by the red line here. If you were to say, I have $10,000 to invest, but I'm only going to have those assets invested when a Democrat is in office, that is the blue line there. And so again, what we're saying here is that over time, for long-term investors, it makes sense to keep your money invested no matter which party is in office. And with that, before I turn it over to Melissa Joy, actually, to talk about the equity markets, I know this is a fun topic for Melissa, so I thought I would just see if she had anything to add as far as elections and her thoughts for investors.
Well, I don't know if it's a fun topic, but by education, I was a political science student in college. And what I learned from that was that I didn't want to spend my whole life talking about politics, but every 4 years or every other year, I guess, we kind of have to. So I just think it's so important that you don't intertwine your perspective on your money with your perspective on elections and politics. I know how important elections are to everyone, and how much they care about the outcomes. But it just is a fool's errand, a shiny object, a pivot away from your financial plan if you're also making your money decisions related to, what the results of a certain primary were. It struck me, Melissa, as we talked about, the primaries in general, this is kind of it's an unusual primary season because there's not a lot of, there's not 8 candidates in the Republican Party, and there's not what seems like a likely contender on the Democrat side. So I'll be curious as to whether those trends of uncertainty continue. And also, I just think that there's going to be more conversation over the next year, especially during the election, but also into 2025 about tax code, because the Tax Cuts and Jobs Act sunsets for much of its legislation at the end of next year. And so that's going to be a growing theme that we talk about on the financial planning side and the investment side. So that is something concrete that will become a part of our conversations with clients. So more to come. Just don't panic when it comes to elections or inflation or all the things. I know our investment philosophy can seem boring because it's just keep swimming, just keep investing, always be buying. But that is the strategy that we know gets people through their lifetime as investors and allows them to use their funds and capital throughout their life, and especially in retirement. So let's talk about a really interesting year, which was last year in the market. Melissa probably hinted at it during our past conversation, but the third year in the presidential election cycle tends to be the strongest year in markets. But I was I remember doing our October webinar and talking about how strong positive trends are when it comes to investments, but really feeling pretty depleted when it came to the way the markets were performing at the end of the third quarter and into the fourth quarter last year. This is a visualization of what happened last year in markets. The purple is the NASDAQ, so that's your growthy companies, and that's where you really got a lot of bang for your buck as an investor last year. And then the S&P 500 is kind of our new Dow Jones. That's the most common index, the 500, pretty much the 500 largest companies in the country, and there you get more in the index for the biggest companies and the smallest companies. And then the Russell 2000 is in blue. That's your smaller companies in the US. And then in green is international companies, the MSCI EFA. And so we really kind of sat around and had a year where it was really a story of large growth companies. And even those came down from late summer through October. And then everything just started to work. and everything ended up higher. The exceptions that last year were commodities, but almost everything else was higher. So it was a really interesting year. It would have been easy to have a head fake and say, here's where the bad news starts to impact markets in the third and fourth quarter. But if you had really, kind of said you're going to sit on the sidelines for that period of time, you would have missed almost all of the returns in the market. Just look at the blue line where the Russell 2000, that's US mid and small companies, especially small, were underwater into the end of October and ended the year up 17%. So really interesting year, and one that you just, couldn't forecast. In fact, we have proof of that. Because when you look at the big banks and what they said was going to happen last year, you just don't see the same results. In this case, we're measuring the year-end price of the S&P. And here we are. There was no one who got it right. Everybody got it wrong. Everybody was more pessimistic than results. And I'll tell you, what sells when you are trying to get people to listen to you is not just keep swimming. It's not a positive, upbeat outlook. It's negative sells. It sells when it comes to, news stories. It sells when it comes to financial networks. It sells when it comes to headlines. And so do not assume that you can pick someone who's going to know what's going to happen this year either. And we just have given up on that. That's not going to be what we're telling you. We do like to deal with probabilities, like something may happen, but we are not going to be in the business of prediction. Smart people say the same thing. Forecasting, this is from Jason Zweig, who's a great writer for the Wall Street Journal. Also has a couple great books. And he says forecasting is the attempt to predict the unknowable by measuring the irrelevant, a task that in one way or another employs most of the people on Wall Street. And hey, we've been there. We've dealt with forecasts. We've listened to people forecasting, but it just ends up costing you money. And so we really are trying to build into our process, our narrative, and our stories, our conversations with you, how we cannot rely on those forecasts. And they're often a great tool for selling, but they're not a great tool for investing. Morgan Housel, who's our current generation's really great voice when it comes to investing, he's written some great books, says it's not truth people seek, it's the removal of uncertainty. And that fact alone will cause them to believe things that have no basis in reality. And I'll go further to say that that need for the removal of uncertainty, for knowing what's going to happen, even if it's horrible news, really costs people when it comes to their pocketbooks and their investment accounts. And Seth Klarman is a legendary value investor. He says, despite the predilection of some analysts to model the financial markets using sophisticated mathematics, the markets are governed by behavioral science, not physical science. And that is a great reminder for that chart Melissa showed you, where people are going to cash in the best years in the market. And in election years, they're saying, I'm going to sit it out and then I'll see what the outcome is and make a decision of whether I'm comfortable investing. That's behavioral science right there. And it ends up costing us money in the aggregate. And we're really trying to work hard with our investment portfolios as well as our client conversations to avoid you having that behavioral science work against you. We really want the science of people's behavior, investors' behavior, to be an advantage that you have relative to peers. And so, that's why this is our theme this month. We really want to remind you. Now, here's an example of the forecast gone bad, just as proof. And just so you can spot these forecasts in real life, because they're out there. This is Harry Dent. He wrote a book in 2009 during one of the best upswings, the biggest combustible bull markets ever. His book was The Great Depression Ahead. But this guy has, he has a big audience. People listen to him. And all he's done is sell more doom and gloom at all the worst times. And when he came out talking about last year, the crash of a lifetime, which was coming immediately, one more new low was coming. Well, that was just before this big boom at the end of the year that I talked about. And so I just wanted to give you an example of what you need to be looking for, because it's hard to spot them when you're in the moment. But these red dots are all the moments where Harry Dent was wrong. And I'll tell you, he's not continuing to say that just for the good of society. He's continuing to say that to sell his perspective. And so I be leery when people have, say they have knowledge of the future. But what can we say in terms of predictability, probability, or what's happened in the past about a year that was so good? A lot of people may be thinking, okay, all the returns were kind of squeezed out of the orange last year. I'd like to sit on the sideline because I'm not sure if there could be such good returns this year. Well, this is a look from our friends at Carson, who do great analytical data work. This is a look from Ryan Dietrich at when you have more than 10% returns in the last couple months of the year. So you had a really good Santa Claus rally. What happens in the future? So what happens in the next month? What happens in the next quarter? And what happens in the next year? Green is up, red is down. And you can see in most cases, when you have such momentum in the final 2 quarters, there are trends toward the positive. That doesn't mean that it has to happen this year, but just like the election cycle information that Melissa's provided, seemingly good news in terms of prospects. It doesn't always mean when you have such good starts that things have to stop. Now let's talk about kind of parts of the market, because really last year was dominated by growth. And we had a respite because I don't know if many of you remember, I started investing and learning about investing in the late 90s in 1999. That was the last great kind of tech bubble that really depleted in after 9/11, where the last like kind of amazing time to be a value investor. Value investing really saved people's bacon. If you weren't all kind of in the hot dot stocks. Melissa, I know you were starting your career at that same period of time. And so on the left, you can see what happened last year. Growth was up. If you looked at the largest companies, growth was up 40%. In the smaller companies, growth was up 17%. If you compare that to value, kind of companies that are out of favor, that look a little cheaper, maybe they're a little more old school in terms of their technology, or they're not all AI. Well, those companies were up about 12% for the biggest companies, or 9% for the smaller companies. But remember, when we look for where could there be possibilities in the future, we certainly still have a large swatch of growth investments in our portfolios. But we also want to make sure we're continuing to own those value companies. We think that that may be a source of opportunity. On the right-hand side, what we're showing you is above the red line is times that growth has outperformed, and below the red line is times that value has outperformed. And you see that big swatch from 2000. It really kind of prevailed itself through early to mid 2010s, because after that point in time, it was kind of catching back up to the growth side. But there are periods of time where value can prevail, and that's why we continue to have diversified portfolios. We've already acknowledged we can't predict what's going to happen next. And so with that lack of capability prediction, we are going to continue to be diversified investors. Also, there was a dynamic last year where most of the returns of the NASDAQ and the S&P, which are cap weighted, so the biggest companies get the biggest percent. That's what cap weighted means. So if you're Apple and you're one of the biggest companies in the world, you're going to have a much bigger percentage in the S&P than the 480th biggest company in the US. And so the biggest companies, the Magnificent Seven, your Apple, your Meta, aka Facebook, your Google, your chip maker NVIDIA, those had 107% returns for those 7 stocks. The very biggest, very brightest kind of stars in the US stock constellation were killing it last year. What that resulted in was a NASDAQ performance of 45%, big portion of NASDAQ, and a US S&P performance of 26%. But these were huge contributors to that performance, and almost everything else was kind of wah-wah, like single-digit returns. Now, you can look at that glass half empty, glass half full. You could say nothing else was working in the economy last year or the market last year. Or you could have the perspective that we have, that there's a lot more that could play out in positive in terms of stocks, because you don't have to always rely on 7 companies to make things work. and there's a lot of room to grow and catch up for the rest of the world. For example, NVIDIA is like the name on everybody's tongue because they create the parts that give you the opportunity to utilize AI. But companies around the world are going to be utilizing AI. I saw a video of a farmer with John Deere who's using AI to tend to his fields when he has a labor shortage. That is going to come through to parts of the economy that are completely different than you would think are kind of the tech crazy boom parts. And so there will be opportunities for competitive advantage filtering in throughout our stocks. And so we think that it, just having returns in a small segment of the market last year is not the worst news ever. I'm going to mention, just as a pause, we're going to get in a few minutes to the end of our presentation, and we would welcome either stump the presenter or asking us to talk more about a certain topic. So please use your Q&A function to let us know what questions you have, and we'll make sure to answer them at the end. Sorry, I didn't mention that housekeeping item at the beginning of our talk. But I want to remind you that it's very common, getting back to the stock conversation, it is quite common to have dips in the market. This is just what we need to be used to as investors. They're head fakes. They are ways to, I'm thinking about the Lions in their playoffs. They're a running back that's moving one direction, then cuts like Barry Sanders the other direction, making it easy for you to miss when it comes to being an investor and decide I need to opt out. But about 7 times a year, we have a 3% dip in the market. 3 times a year, on average, there's a mild correction of 5% pull down. And about once a year, you get a 10% drawback. Every other year, you get a 15% decline. And every 3 years, just about, you get a 20% decline or a bear market. Volatility is the way we pay to be investors. That allows that behavioral part to fit in. And you just can't have great investment success without volatility. Now here is an example. Last year was certainly a year, especially when you had pullbacks in the mid to in the third and early fourth quarter, where you could have said, you know what, I'll just wait and see. I don't love, a war in the Middle East. I hate inflation. I'm just going to sit this one out. Well, in last year alone, if you had just started investing, but you just chose to sit things out along the way, and you happen to miss some of the best days in the markets, this is stunning to me. The amount of just a few days can cause in terms of the performance that you give up. So if you invested every day last year and you owned the S&P 500, you would have been up 24% at the end of the year. But if you sold and didn't own the market in 5 days, the 5 best days in the market, your performance would have been cut in half. That's 5 business days. That's a week. So you would have gone from 24% to 12%. But let's say it's 2 weeks. Let's say you called us, said, I want to be out of the market. I'm going on vacation. I'll call you back after my 2-week trip to Europe. Okay, then you just lost out on, basically you're below inflation at that point. You're down to 3.7%. And if you skipped the 15 to 20 days in the market, that's about a month, 3 to 4 weeks, then you're in the negative. And so I love that visualization. I don't love volatility. You just have to get used to it. You have to train yourself. I tell people to journal when they're feeling really bad. I also tell people to give us a call because we can talk through it with you. And trust me, Melissa and I are not without the same emotions that you feel. It is not a fun week to be a professional investor when markets are down. But we have to remind ourselves of our process, and we have to remind ourselves that our behavior matters in terms of returns. And for that, I appreciate this visualization to really understand the costs of bailing on your investment plan. And I love seeing it in a year that we can relate to, because we just went over those numbers of what happened in that year. Let's talk bonds for a second. And I'm a true investment geek because I'm excited to talk about bonds. They've really been the bane of my existence for much of the last 15 years because their rates were so low, and then it just got really painful to be a bond investor, especially when you have that discipline to maintain your process. But the bond market changed radically in 2022 as everyone had to take very painful medicine with interest rates rising. That was very painful for bond owners because when you own a bond and interest rates go up, the price of your bonds goes down. And that's what you see on your statements. 2023, a little bit different year. I actually was thinking that we might be talking about 3 negative years in a row when it came to bond returns. Again, that's what it looked like in October when we had the lows for just about everything. But lo and behold, you don't need the Federal Reserve to change any, increase or decrease interest rates for interest rates to change. In fact, it's more, the market gets ahead of where the Federal Reserve is and anticipates things. And what happened at the end of last year, you can see, if you look on this chart, you see the blue is like the most used bond index that we have. And then the orange is US Treasuries, and the purple, no, I take it back. The purple and blue are confusing to me. And the purple is the most common index we use, and the blue is corporates. But what you can see is people were getting paid yield. They were getting paid 4 to 6% for these types of investments. And yet there was a perception that interest rates were going higher, which were pushing down the prices into October. But then there was a change in perception. The Federal Reserve's data in terms of employment and inflation seemed to look better for them to, continue to beat down with rate rises. And so the perception that rates wouldn't rise actually meant that rates fell for people. And that's why you see that big pop in prices. I want to remind people of the possibility of that pop, because that's also what can happen when there's negative investment news. When you have markets going down in stocks and bonds can often go up, but it's been difficult to remember that because we've been in such low interest rate environment where there wasn't a lot of room for bonds to go up. We're in a different environment today. And we are not talking about 3 negative years, because in fact, at the end of the year, all 3 types of bonds and many other types of bonds ended up being higher because of the perception that interest rates may go down at some point in the future. Again, just like talking about predictions for stocks, we are not going to be predicting how many rate declines are going to happen next year. I don't care. What I do know, though, is probably the yield curve will normalize. For those of you that have gotten into more technical, kind of conversations about stocks and bonds, people don't like an inverted yield curve, which means that the treasury bills that mature in 3 months pay you more than your mortgage that matures in 30 years, or a government treasury that you get back in 30 years. It's an unusual time period. Sometimes people think it can predict a recession, although I would tell you that in this case, a lot of the reasons for an inverted market have to do with just super quick rate rises in 2022 and into 2023. But right now, your shortest 1-month treasury gives you 5.5%. Think money markets with that. So your cash, if you're tending to it well, can get you between 4.5% and 5.5%. Same with CDs. A 1-year treasury rate is 4.8. So you get paid less to give money for a year than you do to give money for a month. And on down the line, your longer term treasury rates are much lower. But we've seen a pattern where these are kind of coalescing and have the potential to start to come together. At some point, they will normalize. And you may be asking, well, first I'll mention the market anticipates rate cuts. So don't, when people are saying, oh, I think this next summer, the Federal Reserve will lower their rates. Well, if you waited till that day to say, okay, I want to own a bond because I want a bond where the price is going up, well, the market would have already anticipated that. And more recently, it's been even longer term. So in 2006, the market's interest rates peaked in terms of the way bonds traded, and it took until September of 2007 for the Federal Reserve to cut rates. That was 15 months. In 2018, the last example, the market started to sense, hey, we may have a rate cut. It took 9 months for the actual rate cut to happen. So don't think you need to predict anything about when the Federal Reserve is doing anything. Things are really priced into the market. What I do sense is probably a tendency, because short-term interest rates are so high, to say, why don't I just own a money market? But when interest rates start falling, what you get is immediately you have a lower interest rate paid to you in a money market. So if the short-term rates go from 5.5 to 4.5, your money market is going to be paying you 4.5. But if you buy a bond that agrees to pay you 5% over 5 years, as long as that bond stays, has the ability to pay, you're going to get that 5% even if interest rates go down to 4 or 3%. And so that's a way where bond investing versus cash investing tends to work. This is a visualization going back 80, 75 years. No, my math is bad, 95 years, excuse me, to how much you underperform the market by just sitting in cash. Because you probably are looking and saying, hey, 5.5 sounds pretty good. And if this is your safe money, I agree, thumbs up. But over any given year, you're typically going to underperform the average S&P return by 8%. It gets to be quite dramatic over time. So if you just, because of uncertainty, because of volatility, say, I want to sit this one out, I'll be happy to collect my money market. I just want to encourage you to do that with the money you need in the short term, but don't put all of your money into a cash stash. Because it can be very difficult to keep up with either other investments, but also inflation. I want to just have a couple kind of pieces on perspective as we put this all together, and then we'll get to your questions. I see we already have one, and I will welcome anybody else to type anything in. I saw this picture a month or two ago on Twitter. I refuse to call it X, but it's talking about historical perspective. I know even though news was good in investing for the most part last year, it's really easy to feel depleted, diminished, discouraged with the state of affairs in the world. It's really easy to see negative information because we have so much information coming at us all the time. And our caveman brains really latch on to things that may cause us pain or we need to be fearful of in order to protect us. That's just the way we're wired. But this is a look at the generation born in 1900 and what they experienced over their lifetime, coupled with an image of child workers. If you were born in 1900, when you were 14, the World War I starts. By your 18th birthday, 22 million people have died because of the flu. The Great Depression starts when you're 29, unemployment hitting 25%, GDP dropping 27%, only to be followed by, when you're 39, World War II. When you're 41, you're fully into World War II, and you have the Holocaust. The Korean War follows up when you're in your 50s, followed by Vietnam, and the Cuban Missile Crisis. And so your grandchildren in 1985 will be in a completely different world, though. Their life expectancy will be longer. Things have improved. And I feel like we live in a much better world than presented itself back then. And I was reminded of that. I got a chance to visit on a recent trip to London, the Imperial War Rooms, and just the reminders of everything that people went through in the 20th century, between World War I and World War II, but also reminders of how much change has occurred in the world. As a women-owned investment firm 50, 60 years ago, it would have been difficult to have a checking account in your own name. And now we service men and women who are managing more and more wealth. They have opportunities for quality of life. We all do, that were unimaginable in 1900. So just a reminder of perspective, because it can be so difficult to think through things when it comes to all the negative kind of information that's coming at you. I also love this visual from honestmath.com talking about all the noise out there. If you just filter your big rocks of what's most important in your life, and that's what we really try to do. We want to be experts when it comes to investing in the process that it takes to get you to your finish line for your financial goals. But we also want to keep in perspective that more than any of this conversation about which stock or bond or index to own, your spending being less than your income matters more, or you're spending less than your maximum withdrawal rate if you're in retirement. Your emergency fund matters because it totally changes your perspective when something goes bump in the night. Your investments matter too, of course, but you need to be insured against risk. You need to be in the right asset allocation and tax efficient if you're in high tax brackets. But way on down the line, graying out is headlines, technical analysis, fancy things that can cost you more, derivatives, dividends. And I just love this, priority chart, focusing on the things you can control and making sure that you have sound fundamentals in your investment strategy, but also your financial plan in order to be successful over the long term. Because there will always be a reason to sell. We've had plenty recently, but this is just a look at what we've all lived through. This goes back to 1990. I think most of us were around for most of these years, and there have been so many negative things. You'll notice there's 4 gray lines there. Those are the 4 recessions we've had since 1990. But think about all of I did use the R word, Melissa, sorry. But think about all the oxygen and hot air that we utilize in order to get to those points in time. I'm not saying that they don't matter, but I do think that we spend a lot more weight talking about what could go wrong than focusing on the things that can help you be right in terms of how you set yourself up. Okay, I've talked a lot. I want to see if we have any questions. Melissa, did I forget anything?
No, I think you covered a lot, but it was all good stuff. And I did take a peek at the question. So I'll let you look at it as well. But
Yeah.
I did have some thoughts, but I'll let you
Tell me
tackle it.
first and then, yeah.
Well, do you want to read the question and then I'll?
Yes. So our question, thank you, Gary. Can you talk about how the issue of office real estate values could affect the economy?
Well, I mean, my thought, maybe not directly, but if we look at just today, both Melissa and I do have the ability and the technology to work from home, and we are both in our actual offices for this meeting.
Thank goodness, because it's snow day number 6 around my house. I've
Well,
lost
that's what
count.
I was going to point out. So Melissa's kids are home on a snow day. My high schooler had midterms this morning, was done by 10 a.m. and there's like 14 teenagers at my house. I guess there is chatter, like the negative headlines, the commercial real estate set for a crash. I think savvy investors or real estate investors, owners of buildings and such, do have the ability to pivot. Yes, there are more work from home opportunities, but I don't think offices are going away. In fact, a study by KPMG revealed that 63% of CEOs feel that complete return to in-office work will happen by the end of 2026. So work from home is great. The flexibility to work from home, I think, is important, especially to working mothers. However, I think that a lot of the headlines are overestimating just how many people are going to not be working in an office because of these changes. Would you agree with that, Melissa?
Yeah, I think that, I do think it's a big issue. I see there's other retail in Ann Arbor where we live. I drive by Briarwood Mall, which is a ghost town. We don't live right in the big city, but there's a challenge when you're in San Francisco or Detroit and you were really building for a corporate workplace, but it's a small portion of the economy. It's not, I think we're all burned by 2008 and 2009, where real estate had become a much bigger part of the economy. So I do think it's important, and there will be losers who had assumed, that you would have the occupancy that exists in a different way. It's interesting because where I live in a smaller town, it's nice office spaces at a premium, because there's not that much of it. And more people work from their house and would like to get away from, the kids on a snow day or off in the summer. But we really want to hold on to our office space that we have. And the ideal office space I want is not available to me. So I think that speaks to something that is a recurring theme in the economy that we didn't mention yet, though, which is that we had this disequilibrium. We used to talk about it as a K-shaped economy. Some things go straight up, some things go straight down, some things are directionally trending positive, some things directionally trending negative. That's how we characterized it during COVID. And if you want to find a partial recession, a sector recession in the economy at any given moment in time right now, I think it's more disequilibrium than it ever has been. And that's continuation of 2020, where travel sector was dead, then you can't get a flight, and everybody's in a hotel, and now things are slowing. It's really easy to latch on to any one of those sectors is kind of proof that everything's going up, poof. The positive momentum is changing. And so, same goes for layoffs. Big tech and venture capital backed companies had a lot of layoffs last year because the easy free money was kind of disappearing. But then nuts and bolts economy couldn't find workers. And so you really need to step back from the data, do be aware of when things come through, but I don't think it's a big enough portion of the economy to just knock us off. And there's some extremely wealthy money backing that. If you were investing in BlackRock's big private real estate fund, I'm biased because I've been burned in the past by selling to retail investors for things that you don't have liquidity in, and you're selling based on like nothing will ever go wrong because this is how good it is. And then, hey, oh, by the way, now interest rates are 7 or 8%, and it totally changes that portfolio in the neighborhoods where you're buying up a ton of houses and renting them out or things like that. And so there are going to be stories like that. I just don't think it's the biggest portion of the economy. And there will be still normalization. Like I worked from home yesterday, and I was like, when would I ever stop working if I just have my computer open at any given moment in time? I'm a better in-office worker, but it will be different, and things will also be adjusted, buildings retrofitted for housing, or bosses saying, no, we're renting the space, you're coming in, and adjustments to workforce accordingly if people aren't willing to do that. So it's very interesting though to see like some portions just under the gun of our sectors of the economy, and other sectors, gangbusters. And so, but I don't think that's a bad thing for everything to not, maybe that prolongs, kind of economic growth for the country by having, more, when one thing's down, another thing kind of bails it out in terms of the big picture. Couple headlines just mentioning, where to find us. We're at pearlplan.com, as well as, all the social places. And of course, where to give us a call to, or feel free to email us if you had questions you wanted to kind of discuss in private. We look forward, every year is different. That's why we love our job. Your lives are all different. So solving problems, but also putting, the world into perspective to us is so, it's a great job. And so I love looking back at last year because it felt harder than it looks on those charts, but also very rewarding. And with that, I think we'll wrap up. Melissa, anything else?
No, I was just going to add that when I send the replay out to everybody who registered, I will also put the date of our next economic update in the spring. We don't have it yet, but I will get that on the calendar and make sure that it goes out with the replay.
Yeah, we have 7 monthly webinars planned this year, so check back on our events page soon. And with that, thanks everyone.